And so now I would like to introduce our first speaker. And we're actually starting with Richard Yetsenga because we wanted to frame how the pandemic is shaping ESG. And it is a really important point for us to reflect on before we actually frame all the discussion over the next 2 days. Richard Yetsenga has been with ANZ since 2011, and he is ANZ's Chief Economist and Head of Research. Prior to ANZ, he led the HSBC Emerging Markets Strategy and in Hong Kong, and previously held economist roles with Deutsche Bank and the Australian government. He is well recognised at industry level, and I am sure many of you do recognise his name, as he regularly appears on CBNC, Bloomberg, and is an editorial contributor with the AFR, the Australian, Wall Street Journal, and Hong Kong Economic Journal. So we're in really good hands with Richard. But before I hand to Richard, as a warm-up into the forum, instead of you asking Richard questions, we are going to ask you to participate in a question. This poll will pop up on your screen. It will be anonymous, and it will ask you for your personal view. As Helen highlighted, this is a personal leadership journey. I promise you it's not going to be a strenuous question, but I would urge you to answer it. Over to you, Richard.
Thanks, Jackie. Thank you very much. It's a pleasure to be speaking to you today. For me, when I speak about this issue, I'll speak as an economist, I suppose. I can't cover everything to do with ESG, but certainly climate has become more important, I think, to economics, particularly over the past couple of years. COVID itself has resulted in the largest economic downturn in a century. And while in many economies, the downturn was reasonably short-lived and recovery extremely rapid, one of the legacies does seem to be quite a pronounced shift around ESG, particularly climate. The last 4 quarters have seen record inflows into sustainable funds. Sustainable funds. Sustainable debt issuance has eclipsed last year's record, and at 2021 so far even is ahead of last year's run rate. The COVID... Oh, excuse me, I'm getting some technical suggestions here. Sorry, excuse me 1 second. How's that? Is that better? Okay, I'm getting a few yeses, so thanks. Sorry about that. The pandemic itself obviously has its roots in the intersection between humans and the natural world. It also starkly demonstrates, I think, to many of us, the economic cost, the huge economic cost when the natural environment behaves in a way that departs from our historical experience. And in fact, the cost estimates we have around those issues are solidifying as we speak. COVID also has presented us with real world experiments we never could have discovered, I think, in any sort of environment. Land use has even risen in provenance. There's still some debate about whether ESG has improved company performance, but certainly during this pandemic, there's quite a range of evidence to suggest it does. S&P reported many large investment funds with environmental, social or governance criteria outperformed the broader market through the first year of the pandemic. And even in China, a study of companies in China suggests high ESG portfolios have generally outperformed, and ESG metrics have mitigated financial risk as well. They've been a double bottom line winner, I suppose, in that sense. Climate change itself is prone to tipping points. Tipping points are likely to be powerful, I think, because of the concentration in emissions. The G20 economies account for 80% of global emissions. 20 companies account for nearly half. And the richest 1% of people account for about 15% of global emissions. Even in the absence of widespread carbon taxes, which remain difficult for many countries, many economic sectors are shifting. Companies are responding to demands from their investors. McKinsey, in fact, reports 23% of companies in their data set are using an internal carbon charge to identify the risky parts of their business. A quarter of S&P 500 members have made net zero commitments by the end of last year, and that number is still growing. Financial systems have also obviously moved to incorporate climate change risks. All but 2 of the G20 economies are now represented on the network of central banks and supervisors for greening the financial system. A title in need of an acronym, if I've ever seen one. Financial regulators are acting on the basis of climate change as being not just an important financial risk for individual institutions, but also, in fact, for the stability of the financial system itself. And there have been a number of comments on that specifically in the last couple of weeks. The Bank of England's mandate has even been amended to include climate-related goals. Even in a market sense, commodity prices, for instance, are increasingly influenced by climate-related factors, including within individual commodities. Oil, iron ore, both of those, for instance, have seen quality divergences in terms of pricing within those commodity complexes become much more entrenched over the past year. Sovereign bond portfolios have moved less quickly from a climate agnostic position, but the Institutional Investors Group on Climate Change recommends, and I quote, increasing allocation towards higher performing issuers on climate metrics to the maximum extent possible. Climate is also, to use economic language, a classic collective action problem. Actions are by necessity individual, regional, country specific, or company specific. There can only be meaningfully positive progress if everyone's pulling in the same direction. In some cases, upgraded climate commitments are also being accompanied by statements of intent around carbon border adjustment taxes. The world we know is more geopolitically fraught. Discussion of these issues shouldn't be a surprise, but the practicalities of carbon border taxes are myriad and complex. It's unlikely to prevent, I think, ongoing discussion of their application, however. While the shift in commitments is notable, it's actions that will ultimately be most significant. The United Nations 2020 Emissions Gap Report suggested in December last year that the world was headed towards temperature rises in excess of 3 degrees this century, and that presupposes that all national commitments at that time were being delivered. Alliance Bernstein reported following their 2020 ESG engagement campaign that much more is needed from companies to provide commitments that are transparently trackable and aligned with climate targets. Climate Action 100 benchmarked 159 companies across 9 net zero criteria and found less than 1/3 of companies typically meet any of the criteria fully, and none of the companies had fully disclosed how they will become a net zero business by 2050. In a study of 332 financial institutions, the CPD suggests less than half of disclosing institutions and only 27% of insurers have been transparent on actions taken to limit global warming in line with the Paris targets. However, 49% of financial institutions do not conduct any analysis of how their portfolios impact climate at all. Fiscal policy itself has come to prominence during this crisis, can be deployed in a way that achieves both traditional economic targets as well as climate-related outcomes. Unfortunately, the OECD reports that only 2% of COVID-related spending has been allocated to green measures on a global basis. Even delivering the Paris commitment of a 1.5 degree increase in global temperatures implies both damage from climate change, as well as costs from mitigation. The more mitigation actions that are taken now, of course, the less damage we will see in the future. And the economics of mitigation today have improved. COVID notably has solidified the cost of pandemics. Many of the economic estimates of these sorts of events, including from the US Congressional Budget Office and the EU Commission, have proven to be wildly optimistic. One academic study released at the beginning of COVID suggested 15 million deaths, almost unfathomable to think about, but 15 million deaths might cost 2% of world GDP. In reality, worldwide deaths are around 4 million, but the economic cost for the US might be 75% of this year's GDP. The fall in the cost of alternative energy has reduced transition costs directly. More than half of the renewable energy capacity added last year achieved lower power costs than the cheapest new coal plants. Broadly, the fall in global interest rates is improving the economics of renewable energy, which is capital heavy, but running cost light. The costs of mitigation, in fact, keep falling across a range of estimates. One estimate suggests net zero can be achieved globally at a cost of below 0.5% of global GDP. The UK has produced similar estimates. In contrast, Hurricane Katrina cost about 1% of US GDP, and the 2019 Australian bushfires perhaps 5% of Australian GDP. In general, economic studies of the costs of climate change seem modest given the potential human toll and the dislocatory impacts. One comprehensive review of the literature suggests economists reach estimates of climate change that are often a fraction of those from scientists. To quote a famous economist on climate change, Willem Nordhaus, in 1994, natural scientists' estimates were 20 to 30 times higher than mainstream economists. Modelled estimates from economists typically also presuppose pretty smooth adjustment paths, and the past year has shown more than anything else that these developments are not smooth. COVID has also allowed real-world experiments of the sort that wouldn't be possible under normal circumstances. For instance, snowmelt in the Indus River Basin of Pakistan and India slowed sharply in 2020, the suspicion being because of much lower rates of pollution and other pollutants landing on the snow. We also can't continue to assume that future living standards will be materially higher and so use those to pay for the costs of mitigation. The United Nations itself suggests climate change and ecological fragility call into question the assumption that human progress will make the future look better than the past. One study suggests that climate change has already reduced agricultural output by around a fifth over the last half century or so. Swiss Re did some more detailed work. They suggest by mid-century world GDP will be 11 to 14% lower if temperature increases are limited to even 2 or 2.5%. Economies in Asia are projected to be most affected. Deloitte Access Economics suggests unmitigated climate change would shrink Australian GDP by 6% by 2070. Comparatively, the cost of moving to net zero in 2050 might be 0.1% of GDP. So the costs of damage, the estimates of damage have solidified and are much larger than we thought, and the costs of mitigation continue to decline. We're less able to rely on future income gains. The costs of moving to mitigation now, therefore, are falling. And recent mitigation actions, in fact, may not have cost economic growth all that much at all. The IMF suggests climate change mitigation policies have made important contributions towards low carbon activities, broadly without harming overall economic activity. The Breakthrough Institute reports that 32 countries have reduced carbon emissions on 2005 levels over the last few decades and have also managed to grow GDP. And the University of Melbourne, in a study, suggested that of 22 OECD countries, environmental regulations, while they increase the cost of production initially, boost productivity within 3 years, and the gains seem to be quite long-lasting. As well, there are strong arguments that reducing emissions intensity at a company level can generate bottom-line benefits. These trends make the vexed issue of compensation for those impacted more urgent. Mitigated or not, climate change will still benefit some and disadvantage others. The COVID pandemic certainly seems to have exacerbated existing inequalities and created new ones. The policy response itself, with the provision of countries with low short-term interest rates, in fact, interest rates in many economies are at zero, is likely to be socially regressive. Low-income earners typically have savings in cash, lower levels of debt, and spend on essentials, which are often commodity price sensitive. Following any economic adjustment, not all workers will be able to find equivalent employment easily. Locational impacts can be among the most challenging, and we have the experience of trade liberalisation over the last few decades to give us some important guideposts here. In their study of China's emergence as a trading nation on the US labour market, economists in the US find the adjustment in local labour markets is extremely slow. In fact, the word they use is remarkable. With wages and labour force participation rates remaining depressed and unemployment rates remaining elevated for at least a full decade after China's entry to the world trading system. Exposed workers experience greater job churning and reduced lifetime income. It's no wonder that their support for free trade didn't last very long. The complicated nature of compensation should not tempt us to leave it unresolved. The experience with trade liberalisation sends a pretty unmistakable message that support for the agenda can best be sustained if the losses do not fall disproportionately. The experience with trade liberalisation also highlights the very real costs of underestimating the adjustment costs for those negatively impacted. Those disadvantaged by trade liberalisation were also often simply viewed as failing to adjust, reflecting, as Michael J. Sandel put it, and I quote, the tendency of the winners to forget the luck and good fortune that helped them on their way, close quote. The market economy allocates resources efficiently when that allocation reflects industriousness and entrepreneurship, not luck. Judging groups challenged by climate change as undeserving risks repeating the mistakes of trade liberalisation and undermining support for the issue at hand. The idea of a just transition is not new, but acting to deliver one is becoming more urgent if we are to sustain the effort. Out of every crisis, growth trends change. Some sectors are diminished and different perspectives are strengthened. Sustainable finance, the UN's Sustainable Development Goals and the improving economics of low marginal cost alternative energy are not new. But the COVID crisis has brought greater awareness of the scale of the opportunity, solidified the costs when we don't hit the mark, and raised awareness of the potential benefits to the company bottom line. Thank you.
Thank you, Richard. Wow, what a great summary of exactly where we're at. So really appreciate that, Richard. I'd just like to, you covered so much ground for the audience, and it was fantastic how you linked so many of the concepts together. And I'd like to just summarise a few that I've just taken a few notes on, and then maybe pose a few questions for you. One is COVID-19 and the lessons for future transition. And I loved the data that you were presenting about lessons have been learned that actually a lot of the what would be called responsible investment actually is performing better through a crisis. And it reminded me of some research that I saw coming out of Canada and the US after GFC that particularly looked at the sustainable finance debate about companies that had stayed focused on investing in innovation and environmental and social responsibility had recovered faster in their share price, but also took less volatility throughout the journey of the GFC. Now, different situations with a health crisis and a pandemic versus GFC, but it sounds like you were reinforcing the same message. And then the point that you made about commitments of companies and countries to net zero, but posing us on a question whether pathways are being clearly mapped or are they just commitments, I think is a sobering thought for all of us on this call. Your point about international trade and that if the world is factoring in climate change and it starts to get factored in trade agreements, that will hit our economy, but also the other issues in terms of how we compete globally. I want to come back to the cost of mitigation because obviously from an insurance background, that actually intrigues me. And the debate I'm not going to get into about whether scientists or economists forecast better, Richard, I think you're better positioned to take a vote on that than myself. But also you finished on the point of inequality and a just transition, and particularly talking about other transitions we've seen and how we have to think of these employment and skill issues. So I want to weave a few of these areas together and pose a question about, with interest rates being low and consumer spending higher, employment rates are better than expected. That's all sounding pretty amazing given where we thought we'd be a year ago. But you made the point that globally, only 2% of GDP is being spent on green measures or measures that will help us with climate change. What is it going to take for more of the investment to flow to the right things to achieve the SDGs in your view?
Look, that's a good question. I think, one of the stats I quoted was about, where companies are with reference to commitments around net zero in 2050. I think the reality is we can't expect an entity to have a granular plan to achieve an outcome 3 decades out. And this is why I think the journey is so important, and what companies and countries commit to is so important. And that's what the world, I think, is looking to. The recovery has been remarkable, does give us room. And I'm sitting in Australia, and so are you. We're obviously very fortunate through this pandemic. Other countries are still fighting through the worst of it. But I think for countries which have managed it well, I suspect they are turning their minds more intently to what the future holds, thinking more about the lessons of this pandemic. And I think you can see it quite clearly in places like the US, where there's been a shift in leadership and a shift in approach. And that's resulted in some quite remarkable changes in a very short period of time to the government's approach to these issues, and the way they're thinking about this. I think part of this is also, it's kind of a boring data question and a data issue. The more we focus on an issue, the more we understand it, the more measures are available, the more data is available. I think one complication for companies is the lack of, standardisation about what is expected of them. But I think that is in the process of coming through. And in fact, one of the points you picked up that I might expand on is this benefit to companies through this pandemic. I suspect part of this is for those companies that put an ESG lens on their business, which either might not have been there before or might not have been strong enough, and they've strengthened that commitment, they understand their businesses much better than they did before. Their businesses might either have been simplified, or they simply understand their supply chains from the beginning to the end much more effectively. I think that sort of knowledge and understanding is enormously powerful when you face shocks which are outside the realm of your experience. And maybe the last point, the fall in interest rates it's been an important part of the policy response, and it's been an important part of why, with the largest economic downturn in 100 years, we've had the fastest recovery in history. And low interest rates, as I mentioned, in some ways are socially regressive, but also, transport and energy production are two enormous parts of this transition. Low interest rates will help with that, no question, because both of those transitions are very capital intensive. If interest rates were much higher, it would make a much more bumpy adjustment. I think in that sense, there's a few things out of COVID which are smoothing the way.
Thank you, Richard. And I think for all of us, it actually says, well, your point about we can't have a plan that's 30 years out in a company, but what we can do is think about what we're committing to and then understand the goals in 5-year tranches as part of our strategy, and also then the role it plays on governing ourselves in terms of accountability and being able to measure, but also report. The other area I want to explore with you, as I said, coming from my insurance background, is you made a point about actually mitigation is coming down in price in terms of what it costs to actually mitigate for climate change. That doesn't mean adaptation is, but mitigation is. If it is at 0.5% of GDP, and yet our bushfires cost us economically 5%, it seems to me that's a pretty simple mathematical equation, that the more we can invest in mitigation, socially and economically, we will be better off. With the strong capital positions we've got, how do you see the investment in resilience playing out? And I might add some thoughts of myself from my own experience after your comments.
Look, you're right in a sense. The economic equation seems quite clear, but an economist will also say the first best option is a carbon tax, and yet there's virtually no jurisdictions on earth that have a carbon price at the rate which is needed to genuinely address this issue. So the economist in me might kind of lay it out as something that's simple and straightforward, but in the real world, of course, it's much more complicated. Look, I do think your mention of the bushfires is an interesting one, because these events themselves, I think, do change attitudes. In fact, Andrew Haldane, the until recently, I think, chief economist of the Bank of England, gave a great speech quite some years ago. He spoke about a concept called dread risk, which really comes from, the psychological impacts of kind of life-changing events or scarring events. Now, he was using it in economic terms, in terms of talking about the legacy from the global financial crisis and the fact it took consumers and businesses a long time to kind of recover their mojo after that. I think the bushfires for parts of Australia have been like that. I suspect Hurricane Katrina in the US was an event that was similar. I think for many people in the world, even in economies that have handled COVID relatively well, the COVID crisis itself is something that makes us view pandemics quite differently and think that some modest cost to prevent another one is well worth it. So I think the shift in attitudes, you can't put it into an equation. The equation itself is becoming more attractive, but I think ultimately what we need to win, in a sense, are hearts and minds here. And the crisis is giving us, I think, more information to do that.
Thank you, Richard. And it is refreshing to hear from an economist, given a behavioural lens as well, and the growing trend in behavioural economics is so important. I mean, I'd like to add to your point, and kia ora to all our New Zealand participants. I was a CEO of Insurance Australia Group New Zealand for 6 years and had the opportunity to be part of the beautiful country from September 2010, which for those that live in New Zealand know that was when the first earthquakes hit. And then of course, with so many aftershocks after so many years. Your point about, well, what did you call it? The dread factor. I think
dread risk. Yeah.
Dread risk.
It's not a great term.
I've wrote it down. I think it's a wonderful term. I think you have to live it to actually then experience what that really means. And for people living in Christchurch with the amount of uncertainty, but it reminded me that the key issue for the finance sector with the banks and insurers in particular, and the reinsurers globally, was the interconnectedness of the system. So if we didn't all work together with the government at the time, the economic outcome for the whole of New Zealand, if we couldn't secure reinsurance because the ground wouldn't stop shaking, the land sunk below sea level in parts of Christchurch, then the banks couldn't continue to lend. And that, I know there's been a question about what do we mean by sustainable finance. I think sometimes we make it about our own sector or the part that we know in our own sector. But for me, the dread risk became very real for me about CEO of the largest insurer in New Zealand, but also as president of the Insurance Council. How do I actually front the community to tell them that their houses couldn't be insured if reinsurance capital wasn't available? And we often think about investment capital, but reinsurance capital is so important to our economy and so important to the lending and the insurance system here in Australia and New Zealand, which enjoy the highest percentage of property insurance, both for business and for households. And if climate change starts to impact that availability of capital, then it is very hard for us to say we have a sustainable finance system. So I'm going to start reflecting on this dread risk because I've never heard it before, Richard. So thank you.
Look, I think certainly I think about it in terms of, you know, these things affect us in ways that are quite long lasting, even once the event is gone. And just to pick up on some phraseology there, Jackie, I mean, we can't all live these things to convince us to change if the scientists are right. I mean, Miami apparently is considering building a 20-foot seawall to protect the city from the threat of rising oceans and tidal surges. You would think that mitigation would be much cheaper and less disruptive than having to do that.
And Richard, you know, my Christchurch experience and some experience I've had with the Far North Queensland and bushfires here in Australia has been it's usually not the one event. Christchurch showed that there was flooding risk coming out of the sinking of the land, and then also different factors that were hitting society at the same time. And I think your point within your presentation about we actually want numbers to prove things, but there's actually assumptions we need to make and we need to make judgment. I mean, do you have a view on how economists can model that better?
Well, I think we try, and I think we're getting better. The scale, the modelling task becomes more complex as the scale goes up, of course. And many of the examples I gave, I think, refer to smaller scale examples because I think there we can conceptualise kind of the boundaries of the problem better rather than needing to try and, if you like, boil the ocean. And I think what's solidified for me, I think, is our estimates of what these things have cost. Miami seawall is one example of a project we can currently price. Another one is the cost of moving Jakarta. Now, that's not entirely because of climate change, but certainly a city that's built in an area that's too low, that's sinking, You know, clearly climate change is going to show up there very, very quickly when it comes to sea level rises. You could talk to the Italian government about the cost of the structural improvements they need to make to Venice. I think we can see the costs here. They're very large and they're very identifiable, and they're much, much more concrete now.
Thank you, Richard. And I'd like everyone to thank Richard with a virtual round of applause.
Thank you.
It's been amazing setup for the next 2 days. And a question came up in the chat function to the panelists, which was about what do we really mean by sustainable finance? And an answer's been given more generally to the person who'd asked it, but I'd like to give my personal reflection on it. And for me, it's about making sure that we think about how the finance sector is contributing obviously to economic value for the company and to the country, but also whilst defining the societal value. And we will hear a lot more about that tomorrow in the human rights session, but also peppered throughout the next few panels as well. And because it's a very important point, and that's why there's a lot of debate about, is capitalism broken? And you'll hear terms like conscious capitalism, and there'll be a lot of debate about, is that even possible? But we really need to challenge ourselves as a finance sector about how we really think about the value in a holistic sense, because we need to be able to marry the profit, the people, and the planet together. So that's my attempt to also frame that answer to that question. Well, as I said, Richard gave us a great platform to build the next few sessions out. So thank you, Richard. I know you put a lot of thought into your presentation for today. I now would like to move on to the next panel and introduce the panelists. And before I do that, I'd just like to give us a bit of an update on the poll results, because there are 72% of people who responded to the poll said COVID-19 did not impact on our ESG commitments, which is fantastic, because it's my point in my opening address. If we can build on the capability and the leadership strength we showed in the COVID recovery and targeted that more broadly across all areas of SDGs, then we will rise from that position of 37th in the world when we're the 12th largest economy.